I was pulling the financial data for today's show, just, grabbing the latest earnings release and the Form 10Q.
Right, the usual prep.
Yeah, exactly. And suddenly my screen goes completely blank.
Oh, no.
Up pops this massive Cloudflare security wall. I literally had to sit there and click, like, a bunch of images of bicycles to pass a stress test.
The classic, just a moment, verification successful routine.
Exactly, just to prove I wasn't a malicious bot. It's an annoying digital hoop. I mean, we all hate it. But honestly, having to pass a stress test to prove your resilience?
It's basically the perfect metaphor for the company we're looking at today.
It really is.
Yeah, so today we're doing a deep dive into the Q1 2026 financial results of Hexcel Corporation. For you listening, they trade on the New York Stock Exchange under the ticker HXL.
HXO, got it.
And the mission of this deep dive is really to understand how a legacy manufacturing company, one that is just deeply, deeply intertwined with heavy global supply chains, is navigating this relentless series of macroeconomic headwinds.
Because it's rough out there right now.
It really is. We are looking at everything from supply chain bottlenecks and geopolitical conflicts in the Middle East to just wildly fluctuating energy prices.
Right.
Yet, through all of this, Hexcel is delivering surprisingly robust financial growth.
Okay, let's unpack this. Because looking at the raw data you sent over, this goes way beyond just surviving a tough economy.
Yeah, they're not just scraping by.
Right. This is a story of a company actively thriving under pressure. I mean, Hexcel is a phenomenal case study for you listening on how massive macroeconomic challenges can actually become tailwinds. If you happen to be selling the right product at the exact right moment in history.
Exactly. But to appreciate how they're doing it, we first need to look at what they actually build. Because they aren't, like, assembling the airplanes themselves.
No, no.
Instead, Hexcel provides the critical DNA, the literal building blocks of modern aerospace and defense. They're a global leader in advanced lightweight composites.
So I was talking about...
Carbon fiber, specialty reinforcements, and something called prepregs.
Okay, wait, let's translate that for a second. The term prepregs gets thrown around a lot in these manufacturing reports.
It does, yeah. A prepreg is essentially a high-performance fabric, usually made of carbon fiber, and has been pre-coated or, pre-impregnated with a specialized resin.
Pre-impregnated, prepreg. Makes sense.
Right. Think of it like a roll of drywall tape that already has the perfect amount of wet mud applied to it.
Oh, that's a great visual.
Yeah. So manufacturers take these rolls, they mold them into the shape of an airplane wing or a helicopter rotor, and then they bake them in massive industrial ovens.
Wow.
And the result is a structure that is incredibly strong, but just a fraction of the weight of traditional metals like aluminum or steel.
And the manufacturing process to create that raw carbon fiber in those prepregs, I mean, it is intense.
Oh, absolutely.
It requires massive facilities, staggering amounts of electricity, and incredibly high temperatures. It is not cheap.
Not at all.
But when we look at their first quarter blueprint, the financial highlights show they are pulling it off brilliantly. I mean, their net sales hit $501.5 million.
Which is huge.
Yeah, that is nearly a 10% jump from the $456.5 million they did in the first quarter of last year.
But focusing just on the top-line revenue kind of misses the real narrative here.
Right, the top line is flashy, but the real narrative is their profitability.
Exactly. The earnings metrics are where the story really takes shape. So their GAAP diluted earnings per share.
And GAAP is just the standard accounting rules, right? So they can't hide bad math.
Right. Strict regulatory rules. So your GAAP diluted EPS jumped from 35 cents to 49 cents per share.
That's a massive leap.
It is. And their adjusted operating income surged 49% to $67.5 million. But honestly, most impressively, their gross profit margins expanded from 22.4% last year to 26.9% this quarter.
That margin expansion is what really caught my eye. I mean, they aren't just selling more carbon fiber. They are keeping a significantly larger chunk of cash from every single new roll they sell.
Yeah, they are.
And that brings up a concept their CEO, Tom Gentile, highlighted in the earnings release. He talked about the company, quote, growing back into existing capacity.
That's a vital concept.
It really is, especially for you to grasp when analyzing any heavy manufacturer. It's called operating leverage. Think of it like like owning a massive state-of-the-art factory.
Right.
You've already paid the billions to build the walls. You are already paying the monthly bills to keep the massive ovens hot, the lights on, the baseline staff on the floor.
Your fixed costs.
Exactly. Those are your fixed costs.
And once your sales volume crosses the threshold to pay off those fixed costs, the math changes completely.
The revenue from the very next product you sell doesn't have to pay for the factory roof.
Exactly. Almost all of that new revenue drops straight to the bottom line as pure profit.
I understand the theory of operating leverage, sure, but I have to push back a little on the reality of it here.
Okay, lay it on me.
Well, as we just established, aerospace manufacturing is notoriously expensive. The raw materials are costly. The quality control is rigorous because, lives are literally on the line.
Right.
And energy prices aren't exactly cheap right now either. So how did they achieve nearly a 5% margin expansion in a single year just by, turning the dials up?
Well, what's fascinating here is that the secret lies in the normalization of their supply chain, combined with rising commercial aircraft build rates.
Oh, okay, so the bottlenecks are clearing.
Yes.
Yeah.
Over the past few years, the entire global aerospace sector was just choked by bottlenecks. You had logistics, nightmares, missing parts, chaotic delays in production.
Factories were running super inefficiently.
Exactly. But what we are seeing in early 2026 is that pipeline finally unclogging. Airbus and Boeing are building planes at a steady, increasing rhythm again.
And because Hexcel already had the massive factories built, they didn't need to spend new capital to meet this surge.
Right. They just let the factory floor run at the speed it was always designed for.
They smoothed out the manufacturing rhythm, which essentially drives down the cost of every single piece of carbon fiber they produce.
It drastically improves their efficiency. I mean, the financial report even notes that currency exchange rates actually worked against them this quarter.
Oh, really?
Yeah, it cost them nearly a full % in operating income due to a strong U.S. dollar.
Wow.
And they absorbed that currency penalty and still grew their profit margins by 4.5%.
That is wild. Well, to figure out how they grew those margins so aggressively, we really need to look at what they're actually selling. We have to split the business apart into its two main wings.
The commercial side and the defense side.
Exactly. The first wing, which makes up 66% of their year-to-date sales, is commercial aerospace. And this segment is absolutely soaring.
Yeah, up almost 19%.
19%, up to $332.7 million. And the sources show this isn't just like one lucky contract with a single manufacturer.
No, it's across the board.
Sales increased across all four of the major global programs. The Airbus A350 and A320, alongside the Boeing 787 and 737 MAX.
Which are the big workhorses of the sky.
Right. Even their other commercial aerospace category, which covers regional jets and luxury business jets, saw a 15.6% bump.
We are basically witnessing a broad-based global recovery in air travel, and that translates directly into demand for new hardware.
Because airlines are frantically upgrading these aging fleets.
Exactly. And because modern aircraft rely so heavily on advanced composite materials to shed weight and to meet strict new emission standards, Hexcel is just perfectly positioned to capture a massive portion of that upgrade cycle.
Okay, so that's commercial. Then we flip over to the second wing of the business, defense, space, and other, which makes up the remaining 34% of their sales.
Right.
Now, according to the 10Q, this segment actually dropped by 4.3%, falling to $168.8 million.
Yeah, the surface number looks bad, but this is where you really have to read the footnotes.
Okay, what's the...
That decrease is an accounting illusion. Back in September 2025, Hexcel sold off an Austrian-based industrial business.
Oh, so they divested a chunk of the company?
They essentially amputated a small piece of the business, yeah. So if you strip that divested business out of the math and look strictly at their core defense and space operations, sales actually increased by 2%.
Okay, hold on. I'm still not convinced that is something to celebrate.
Fair enough.
A 2% growth rate in defense. I mean, we are looking at a world that is arguably more volatile right now than it has been in decades.
Yeah, it's true.
Defense budgets are swelling globally in response to conflicts in Europe and the Middle East. 2% feels incredibly sluggish for a company providing materials for military hardware. Is that really a win for Hexcel?
It is a fair critique for sure, and it highlights an internal drag within that specific segment because the military aviation side is actually performing well.
Okay.
They are seeing strong organic growth driven by European fighter aircraft and military helicopters across both U.S. and allied programs.
So what's the drag?
The anchor weighing down that overall number is the space sector. They experienced significantly softer year-over-year demand for space launchers and rocket motors.
Ah, got it.
So while the terrestrial defense portfolio is capitalizing on those expanding global budgets, the space slowdown is kind of masking that growth, which results in that blended 2% figure.
That makes sense. But that volatility you mentioned isn't just driving defense budgets, it's also actively threatening their own supply chain.
Oh, absolutely.
In the report, CEO Tom Gentile specifically calls out the geopolitical uncertainty in the Middle East, because Hexcel does not operate in a vacuum. Like we discussed, baking carbon fiber requires a ton of energy.
And the raw chemicals are derived from petroleum.
Right.
Following the conflict escalation in the Middle East, Hexcel noted they are actively monitoring the markets to try and mitigate near-term impacts to their cost base. I mean, a prolonged conflict in an oil-producing region precipitates cost pressures, shipping bottlenecks, just massive inventory challenges for anyone relying on petroleum derivatives.
Here's where it gets really interesting, though. If you look at the macro picture, there is a fascinating paradox regarding oil prices.
The oil paradox, yeah.
Common sense says high oil prices directly threaten Hexcel, right? Because they drive up the cost of manufacturing and shipping. You would assume a spike in oil is terrible news for their bottom line.
That would be the logical assumption.
But, as Gentile points out, high oil prices put massive, immediate financial pressure on the airlines buying the planes. When jet fuel costs skyrocket, airlines become desperate for fuel efficiency. And how do you make an airplane burn less fuel?
You make it lighter.
Exactly, you make it lighter.
You strip out the heavy metals and you replace them with Hexcel's lightweight composites. So the very same macroeconomic factor that threatens to drive up Hexcel's costs, expensive oil, actually acts as a massive demand multiplier for their commercial aerospace segment.
It forces their customers to buy more of their product. It's basically a built-in philosophical hedge. The worse the oil market gets, the more their customers need them.
It's a brilliant position to be in.
It is. But a multi-billion-dollar company cannot just rely on an ironic paradox to protect its balance sheet, right? They have to have actual mechanical defenses in place to manage these cost fluctuations.
They absolutely do, and it involves some highly sophisticated financial engineering. Hexcel doesn't just, hope energy and currency markets behave.
Right.
They actively buy derivative financial instruments to lock in their future reality. For example, they have a massive manufacturing footprint in Europe, which exposes them to currency swings.
Okay.
So to protect against this, they hold $380.7 million in foreign currency forward contracts.
Wait, how does that actually work in practice? Are they just hoarding piles of euros in a vault somewhere?
No, not at all. Think of a forward contract like locking in the interest rate on a mortgage months before you actually buy the house.
Okay, I track with that.
Hexcel signs an agreement with a major bank that guarantees they can exchange U.S. dollars for euros and British pounds at a specific predetermined exchange rate all the way through September 2028. It doesn't matter if the euro completely collapses or surges to record highs next year. Hexcel already knows exactly how much their European operations will cost in U.S. dollars, which allows them to plan their profit margins years in advance.
That is so smart. And they do something similar with their raw materials, right?
Yes, they do.
Because the 10Q details $14.8 million in commodity swap agreements specifically for a chemical called propylene. And propylene is a principal component of acrylamide nitrile, which is the foundational chemical ingredient they use to weave carbon fiber.
Right. And the mechanics of a commodity swap are brilliant. A swap is essentially a side bet with the financial institution.
A side bet.
Yeah. Hexcel knows they need to buy thousands of gallons of propylene every month. If the price of propylene suddenly jumps in the real world due to an oil crisis, Hexcel has to pay their supplier that higher price.
Which hurts.
Right. But the bank they made the swap agreement with pays Hexcel the difference.
Oh.
Conversely, if the price of propylene plummets, Hexcel buys it cheaply from the supplier, but they have to pay the bank the difference.
So the net result is that Hexcel's cost for that chemical never changes. It just draws a straight line through all the chaos.
Exactly.
They are building financial shock absorbers. They engineer the risk right out of the equation.
It is textbook margin defense. They know exactly what their materials will cost them through December 2027, completely insulating them from the volatility of global oil markets.
So they have shock absorbed the future. But legacy manufacturing companies always carry ghosts from the past, right?
Always.
Managing a sprawling industrial empire leaves a physical and environmental footprint. How does a company like Hexcel handle its historical baggage while trying to fund all this future growth?
It requires a really delicate balancing act of capital allocation. And we see two specific structural cleanups in their Q1 financials. First, there was a $5.5 million restructuring expense to shut down an older industrial manufacturing facility in Leicester, in the UK.
So they are trimming away less profitable operations.
Exactly. But the second issue is much larger. It's an ongoing environmental liability related to the Lower Passaic River Superfund site in New Jersey.
Oof, yeah. Environmental law can be incredibly tangled. I mean, the site is governed by the Federal Comprehensive Environmental Response Compensation and Liability Act, which most people just know as Superfund.
Right. And the critical mechanism you need to understand about Superfund law is that liability can be joint and several.
Meaning what, exactly?
In plain English, if a river was polluted by 50 different companies over 50 years, the government can sometimes go after just one of those companies for the entire multi-million-dollar cleanup bill if the other 49 companies have gone bankrupt.
That is a terrifying prospect for corporate balance sheets.
It is.
And the sources show Hexcel is one of roughly 120 potentially responsible parties, or PRPs, related to their former Lodi, New Jersey facility. The government has been investigating this for years.
Decades, in some cases.
Right. Currently, there is a pending December 2022 consent decree for a $150 million settlement to the EPA. 84 of these companies, including Hexcel, have collectively placed that $150 million into a massive escrow account.
Which is good. The money is there.
Right. The district court approved the decree in late 2024, but it is currently on appeal, with legal briefings just wrapping up in January 2026. It is a lingering, expensive legal headache.
It is a headache for sure, but the financial threat is heavily diluted. Because there are 84 viable companies splitting that settlement, Hexcel's management notes they do not expect their final slice of the liability to be material to their overall financial health.
Okay, so it's a known quantity at this point.
Yeah, in fact, they currently only have $100,000 set aside in environmental accruals for it.
Okay, but this is where I have to ask the obvious question regarding their strategy.
Go for it.
If I am running a company dealing with factory shutdowns in the UK, massive ongoing environmental lawsuits in New Jersey, and I'm trying to navigate global supply chain bottlenecks while war rages in the Middle East, I am hoarding every single dollar I make.
You're building a cash fortress.
I am building a cash fortress to weather the storm. Why on earth is Hexcel spending hundreds of millions of dollars buying back their own stock right now?
Well, if we connect this to the bigger picture, you will see that Hexcel's capital allocation strategy is an aggressive signal of supreme confidence.
Confidence.
Yeah. They aren't hoarding cash because their balance sheet is already fortified. Look at their debt maneuvering in Q1. On March 31st, 2026, they completely refinanced their $750 million senior unsecured revolving credit facility.
Let's define that real quick. A revolving credit facility is essentially a massive corporate credit card.
Precisely. They negotiated a new card with a $750 million limit, and they pushed the expiration date all the way out to 2031.
Oh, wow.
And currently, $450 million of that credit limit is completely untouched.
So they have nearly $500 million in an emergency safety net sitting right there.
Exactly. Because that net is in place, and because the factories are running so efficiently, they are generating massive amounts of cash. They don't need the cash to survive, so they are returning it to their investors.
Right. They executed an accelerated share repurchase program, paying $350 million upfront to take delivery of 4.52 million shares of their own stock.
Which is a huge move.
It is. And for anyone wondering why a company does this, think of a company's total value as a pie. When a company buys its own stock and retires those shares, it is essentially removing slices from the pie.
The overall pie doesn't change size.
Exactly, which means the remaining slices suddenly get slightly bigger. For every investor who holds onto their stock, their ownership percentage and their earnings per share goes up simply because there are fewer shares in existence.
It is a phenomenal way to reward shareholders without paying heavily taxed dividends. And Hexcel still has over $380 million authorized for future share repurchases.
They really are confident.
They aren't backing down from their future projections either. Despite all the macroeconomic noise, they reaffirmed their full-year 2026 guidance.
They project sales between $2.0 billion and $2.1 billion.
And more importantly, they expect to generate free cash flow of greater than $195 million.
Free cash flow being the pure cash left over after they have paid all the bills, paid the salaries, and maintained the equipment.
Right.
They project their capital expenditures, the money spent on upgrading or building facilities, to stay under $100 million. They don't need to build new factories, so the cash just piles up.
And that brings us full circle to the concept of operating leverage. Because their capital expenditure needs are low, that margin expansion we discussed translates directly into cash generation.
They have the flexibility to fund daily operations, handle legacy legal liabilities, pay a quarterly dividend to investors, and buy back hundreds of millions of dollars in stock.
So what does this all mean?
If we pull all these threads together, we are looking at a company masterfully playing a complex defensive and offensive games simultaneously.
It's true.
Hexcel is leveraging a post-pandemic aerospace boom to drive massive top-line sales. But more importantly, they are demonstrating the sheer power of operating leverage, showing you that looking past the revenue to the expanding profit margins is where the real story lives.
And they are managing severe geopolitical and energy risks, not with hope, but with mechanical financial shock absorbers.
Yeah. And they are cleaning up their historical baggage while generating enough excess cash to buy back their own stock by the millions.
It is a masterclass in operational discipline. I mean, they understand their indispensable position in the supply chain. Boeing and Airbus cannot build modern aircraft without them.
No, they can't.
By managing their internal costs and hedging their external risks so strictly, they ensure that global demand translates directly into massive shareholder value.
It really makes you rethink what it takes to survive in today's economy. I mean, as global instability rises, as supply chains fracture, and as resources like petroleum become increasingly volatile, we have been conditioned to think of corporate resilience in terms of heavy armored mass.
All right, we think of companies building moats and fortresses.
Exactly.
But it begs a fascinating question for you to consider as we wrap up this analysis. Looking at Hexcel's incredible success this quarter, could the ultimate corporate survival trait in the 21st century actually be like waiting?
Oh, wow.
The ability to do exactly what you did before, delivering the exact same strength and performance, but with half the mass and twice the efficiency.
That is an incredible thought to leave on. Evolving to become lighter, faster, and more adaptable might just be the absolute best defense mechanism a company can have. Thank you for joining us on this deep dive. We'll see you next time.